Hi, good evening. This is Neil Yon. This is thetaxjournal.com, and this is for purposes of accounting 452. And one of the things that I've done here is we're currently going over what I'll call the reorganizational components under Section 368 of the Code. And one of the more important areas that are to note is Section 368D, which is a divisive reorganization. And by divisive, you have an old corporation, and clearly something within that old corporation is going to spin off, split up, or otherwise. And one of those cases that we're going to illustrate now is what's called a 368D spin-off. And let's say, by way of example, we have old company. An old company's been operating in, it's got a particular division that is what we'll call exposure to a significant amount of liabilities, and if there's a significant amount of risk associated with that business. And what's appropriate then, or what the shareholders would like to do, is actually spin that part of the company off so that they're in essence limiting the exposure or the liability. There can be some other reasons, family tax planning, disharmony among shareholders, etc. But typically this is a great way in this case to mitigate against a dangerous activity that you'll be engaging in by way of one business and protect the balance of it. So let's say this. We have old company, and it decides it's going to spin off its dynamite excavating business. What happens then is it will then take all the assets associated with the dynamite excavation, spin them off into new company. As a result, certain original assets will go into NewCo. NewCo then, at minimum 80% of the stock, i.e. the control, must come back to the original shareholders. And you're going to say, okay, this is a spin-off. What have you spun off? Well, we spun off the dangerous activities associated with the dynamite excavation into new company. It issues the stock, but the stock actually goes back to the original shareholders of old company. So now what you have are two separate companies with the original shareholders owning old company, but also there's an 80% control requirement. The original shareholders also own then and control new company. As a result, we have two separate businesses that are, at the end of the day, the original corp or old company, new company, all owned by the same shareholders underneath, and we've passed the 80% test. There are some additional requirements, but this is a brief illustration of a spin-off. Some of the other type of 368D reorgs that we could possibly and will go through are what are called split-offs, split-ups as well. And those are other AVI files, but this is a brief illustration of a spin-off. Thank you.